Welcome to the FinLink FinCast, where we talk about everything wealth management, especially as it pertains to M&A. Here is your host, Xander Heinen.
Welcome to the FinLink FinCast. Today we're back at Live Oak Bank, and we have Wayne Hewett here, who's the head of business development. And we wanted to talk with you today about bridging the gap between G1 and G2. This is something that I hear a lot of, and I've spoken with you in the past many times about this. And I know you've been traveling quite a bit, so you've probably been hearing this as well.
Quite a bit, yes.
So basically the scenario, a founder, what we call a G1, has built a strong business. They have a capable next generation leader, your G2, who's proven their ability, their willingness to really buy in, but the buy-in never happens. G1 kicks the can down the road, and eventually the G2 builds their own base and gets out on their own and builds their own book. So today we're not really going to talk about the product aspect necessarily, but really the solution to this problem that you and I are seeing in the industry more and more. Really, solution based. So let's unpack this a little bit.
Okay.
Let's just start, how often are you seeing these scenarios? Where are you seeing them?
I'm seeing it everywhere. Just for a little backstory, I've been traveling quite a bit this summer, and I've been attending industry conferences. I've also been out on the road meeting with individual advisors and their firms. And in the industry conference, internal succession is something that's always they're talking about, and it's a question that always comes up. And depending on which conference you attended and who's doing the stats, the numbers will be slightly different, but the trend is still the same. And it's the ability of the G2 or G2s or 3s to be an ultimate internal successor is really starting to diminish because the business is growing at a rate or is at such a size. Financially, they're never going to be able to afford it. And then the other thing, when I was in the Southeast region visiting a few weeks ago, I met with two former clients who had reached out and said, hey, we need to talk because I've had something happen. And it was the exact same story. A handshake agreement of, hey, yes, I'm going to let you buy in equity. And it never happened. And the G2s weren't demanding ownership. They actually wanted to buy into the business, but just never, ever came to fruition. And as you mentioned in your opening, they got to a point where they have enough assets under management that if they're going to build equity, they're going to build their own. So now they've left. It's a no-win situation because the G2's kind of having to start over a little bit. The clients that had been working specifically with them now are kind of whipsawed a little bit. And then the G1 or founders, in one specific situation, that G2 was tapped to be the successor. And now I wouldn't say it's at the 11th hour, but it is definitely in the fourth quarter of that G1's career. He's now got to start looking for another successor. So depending on time, internal may not be an option for them anymore. They may have to go external. But that's kind of the backstory. That's what I've been seeing a lot and very consistent messaging over the summer and early fall.
Yeah, that's a common theme. We always tell people to have their succession plan on paper the minute they start their business. We've had a couple situations where you're at the 11th hour because of maybe something pops up like a health issue or something, and that's not a good place to negotiate out of. So always have your succession plans in place, not just a continuity plan. So for those who aren't familiar, Live Oak Bank has a dedicated equity or partial buy-in program that helps facilitate internal transactions. Can you walk us through what that looks like in practice?
Yeah, kind of the way I walk through it is one of the first things I like to stress with G1s. And today I just want to share some things to get people thinking as far as from that aspect. So it's a conventional loan product. The great thing for the G1 or the founder is they don't have to be on the loan. We're lending, and the G2 is the one that is ultimately going to be the individual guaranteeing the loan. So that's a great thing. But both the advisors, when I spoke with them, they're like, we weren't aware this was available. And so they asked a few questions. And ultimately, one of the things, and I think we were going to kind of get to this, is for a G1 or a founder, it's a great way to de-risk. Take some chips off the table from that aspect. I share a funny, or not a funny story, it's actually a very disheartening story, was a family member many years ago. The family farm was the retirement. The children didn't want to succeed. It had grown, and that was ultimately was going to fund the retirement. Unfortunately, he wanted to retire right back in '07 and '08 when the real estate market collapsed in the coastal areas of the Southeast. And so his retirement was impacted. So I know that's in a kind of an extreme story, but that we see happens quite often. So for founders, de-risk, take some chips off the table. You've built a fabulous business. Why not go ahead and monetize some of that? Doing fixed terms, as your CPA generally will allow you to recognize as long-term cap gains. So that's a great thing. But that's one of the things that I like founders or G1s to think about, kind of start, thinking on it a little bit, but it's never hurts to take a little bit of chips off the table. I've never had a founder that actually did it regret taking de-risking a little bit.
So let's get in the shoes of the G1.
Mm-hmm.
What's this look like from a deal perspective? Is this an asset purchase? Is this some partial equity, like a typical equity acquisition? What's it looking like from the G1's point of view?
G1 point of view, typically they're selling a certain percentage of it, and I've seen everything from maybe younger advisors, maybe a 5% buy-in, to more tenured G2s that pretty much have kind of been identified as this internal successor. Typically those I'm seeing somewhere between 20-25% of the business that they're buying into it. 10-year term, 10-year amortization, but really what it does is it kind of allows the G2 to buy into it, and ultimately it's going to determine what the G1 or founder is comfortable with. One of the number one objections that I hear sometimes from the founders is, well, I don't want to, I'm selling now, it could be worth more. But you've got to understand, you're not gifting this to them, you're selling it to them. They're coming to us or to another lender, they're putting their name on the line, they're obligated to pay it back, so they're going to be motivated. My predecessor used to always use the analogy, no one thinks they have an ugly baby. You allow that G2 to buy in, you might be surprised how much more effort you might see coming out of them now that they're a business owner and have a little bit of skin in the game.
And having skin in the game is what it's all about for a G1. So you mentioned, you see 5 to say 20%. I know these typically work on tranches. What are you seeing as a typical tranche deal? Like, you get your first 5% this, first day, right? And then how long are you typically seeing a buy-in? And hopefully, I guess they're getting to a place where either one or a bunch of them are going to get 51% ownership.
Absolutely. If I were to give kind of a paintbrush approach, it's typically 5 to 10, then a 25, or we'll see for a very seasoned G2, maybe 50% or 49% as far as that. Ultimately, it's what they can afford, and it's about structuring the tranches. For the G1s, I tell the G2s, be very understanding, because this is their baby. This is what they've done for 20, 30, 40 years. And for a lot of advisors, it's very hard to let go. And so, situation I'm working on right now, having a conversation, the G2 bought in 50%, and it was I think they paid it off early, about 8 years ago, as far as that. And so now they're having more conversations. Mm-hmm. And what they're going to, I think the way they're looking to structure that one is 25%, with the remaining 25% left to be determined, just because the G1 or the founder's like, I don't really know. He's ready to take the risk off. He's ready to monetize, if you will, from that aspect. Maintaining the legacy of the firm the two of them have built over the last decade is very important. But for him, he's going to hold on to that last 25%, kind of more of a glide path, just because, as we joke sometimes, he probably needs to start developing some hobbies outside of working, so that, as far as that. But to answer your question, first one, usually 5, 10, or 25. Then there's ultimately that 50. And then what I'm starting to see on the last half is kind of maybe a controlling interest. We always do recommend kind of have more of a formal time frame in mind, but kind of giving them that glide path to kind of let them exit kind of on their terms.
Right, and for a younger G1, I mean, it's really cash flow dependent. So
Yeah.
a smaller buy-in at first would definitely help out in the second, third, fourth tranche.
The first one's going to be the most painful, we like to say, but after that becomes a lot more. We joke, how do you eat a whale? One bite at a time.
Yeah, I've heard it with the elephant.
Okay,
So.
fair enough.
So as far as cultural fit, obviously it's a lot easier than a normal straight up acquisition, right? Because you're not finding someone new. These people have serviced your clients. They know your clients. They know your book of business, how you transact business. What have you seen? Has there ever been any hiccups in this, or are you seeing mostly a very positive experience from the partial equity buy-in program?
When they're getting to us, we're seeing a very positive experience. Coming from my consulting background, one of the things that we quite often would see, or conversations I would have with G1s, is the G2. They didn't feel comfortable with the G2 having all three of the kind of core skill sets that they needed: the executive, the administrator, kind of the head of sales or marketing, if you will. So by the time they're now getting to us, they have found that individual or individuals that can fill those three key roles. And so when it gets to us, it's an issue. It's not really an issue. They're very comfortable with it. I think as far as for some G1s that are out there, you may have a great associate advisor. This is that opportunity for them to kind of step up and really think like it's a business owner. I'll be honest with you, where I see this more often is when all the advisors have the same last name. It's those family situations where the G2 is look, I've got 2 kids, and am I soft on them on a lot of aspects? Absolutely so, but it's a business. So
Right.
having that, showing that moxie so that they're able to go out, get the actual loan, that for a lot of G1s, that's that catalyst event that they need to say, yes, this is my person. This is who's going to take us, into the next 20 years.
Right. Tell me about, you kind of mentioned it before, they're going to get a G2, and they may think they're going to sell it up front, and they may not get all that money up front, but they're somewhat kind of allowing that person to have a little chunk, invest in themselves, be able to support future buy-ins. There's a huge problem in the industry right now. There's not enough young advisors to buy into books.
Yes.
I've unfortunately seen it where G1s can't buy in, and the seller has to go out and sell to another firm. Are you having those conversations with G1s about, start this early so this doesn't happen?
The analogy I always use is when advisors are working with clients, is it easier to start planning for retirement when the client's 62 or 42? It is the exact same thing in the actual business. So, I'm not going to lie. There are some individuals that they've kind of missed the window. So from a legacy standpoint, if they want to keep it internal, they're going to be doing a seller finance note for a very large amount. So what I would say is, if you're an advisor, you're that founder, G1, and you're 52 or younger, you really want to start thinking about this topic as far as that. One of the key things I like to stress with this, it's a retention tool.
Yeah.
Because you ask any advisor, the probably number one issue they have is retention. And so you find that good advisor, one that can truly be that leader, executive, the administrator, the head of sales. You want to lock them up as far as from that aspect. So that's a great issue. Find them. Here's another one. Advisors are always looking. They're always recruiting.
Yeah.
To your point, we have a talent gap in our industry. And so to find those good advisors, that next generation of advisors, if you want to attract them, you're going to have some type of pathway to equity or to ownership. And so, even if you've got many years till retirement, this is something to think about. I hear all the time, how do I find good folks? A lot of different ways. That's an entirely different conversation for another podcast. But when you find them, this is a great retention tool, or a recruiting tool to really have them draw them in to your business.
Right. And just a side note, and I don't think I mentioned this to you, but FinLink just revamped our whole recruiting. So if you are looking for Gen 2, we do offer.
I was kind of teeing you up.
Yeah, well, thank you. I appreciate it. You're a good man. But we do offer a tool to help, as that is a huge solution that we are trying to, a huge problem we're trying to address with a solution.
Absolutely.
So on FinLink, we have your mom and pop shop up
Yep.
to your mega RIAs. What size are you typically seeing with these loans? How big is the practice size, AUM wise? You know, what structure look like? Are there ensembles? What's the
I mean, I think
spectrum?
the kind of spectrum is I would say, you know, you've got some different things. When we're talking about a large, truly large RIA, north of $1 billion of assets under management, let me back up. Those firms, they've already kind of addressed it, and most of those firms have it. I think where we're interacting with a lot of advisors, I would say really are probably somewhere between that 100 million of assets under management and about that 500 million. It could be RIA, it can be an independent broker, dealer, advisor. From that aspect, it's not a solo practitioner. It is generally, I would say maybe more of a silo type practice, but I would say ranging probably that 100 to about $500 million of assets under management. And it's typically, because here again, having an honest conversation with G1s, you've interacted with your associate advisors, you know whether they're really ready or not. Typically, we're seeing advisors probably with about 7 to 10 years of experience in the firm. Now, it's football season, so I'll always use this analogy. If you've hired Patrick Mahomes, we might be having this conversation after a year or two, and there are a couple of situations that I'm helping teams with right now, but it's generally more of a silo type approach. It is a 100 to about a 500 million as far as assets under management, and we're typically seeing, I'd say, a solid 7 to 10 years of experience underneath that advisor. Because typically that situation, they came in very new, very raw, and they've really cultivated it.
Right. And then are there teams doing this all into a retiring a G1? Have you seen that?
Yeah, we are seeing that as well. We are seeing some businesses where you've got a couple of the G2s. I would probably say we're typically seeing them late 40s, early 50s, kind of as a general age band. You've got the founding advisors that are between 60, 65. And then they are, luckily, most of those situations, they've already acquired a little bit of equity, but yeah, buying out that remaining partner from that aspect of it. The key thing is there's no one size fits all. The great thing is I tell everybody, reach out, give us a call. Let's spend 30, 40 minutes. Let's understand the situation because, to be quite honest with you, with some teams that we've talked to, one of the first steps they actually need to do is kind of get a little bit more formal, have some formal agreements in place. It's been kind of more of a handshake agreement at this point, and so we do need to put a little bit more structure to it.
Right. So, first step when they're brainstorming about a G1 to G2, give you a call.
Give me a call.
Have a conversation.
Yeah.
And then we can bring in all the other professions to legal, whatever you need.
Absolutely. I give out my telephone number. People think I'm crazy, but it's area code 704-728-1274. Give me a call. I'm going to give you an honest opinion of where you need to go to first from that aspect of it. But yeah, the first step is just reach out. A lot of folks try to do this themselves, and I think sometimes that kind of takes them down a path where it might not be the best direction.
Right. And they can certainly, anybody listening can certainly email me, and I'll get you in contact with Wayne to have that conversation. I'll even be on that call.
Yeah, sounds
if
great.
you'd like. But this has been great. I think, a real key thing I want to leave with our listeners today is you should get this done sooner than later. I think you can agree with me that it's quite odd that we work with people in the retirement planning community who don't look at this until it can be too late. So again, Wayne, I appreciate your time. Give him a call at Live Oak Bank if you'd like to talk more about a G1, G2 partial buy-in, or email me at xander@fin.link. We appreciate your time today. Wayne, see you
Appreciate it.
soon.
Great to see you again, buddy.
Take care.